There are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Hello everyone and welcome to this Rask Live. I hope you can hear me loud and clear. I was just having some issues with my internet. It kept shutting down on me for some reason. Must be something in the air here in Newcastle where I'm joining you live from. I'm here in my hotel room. I got in a little bit earlier today on the road for a couple of events. I was in Port Macquarie last night with a wonderful small group up at Settlers Inn Hotel, if you know it, in Port Macquarie. It's a beautiful part of the world. And tonight we're doing a Rask Roadshow event here in Newcastle. And it's going to be an amazing event. We've got so many great speakers. Even one of my peers, Glenn James from My Millennial Money, the team from Waddle Partners. It's going to be a great night, Global X. So if you are in Newcastle or within striking distance of this beautiful city, come along because it's $40 a ticket. You can just Google Rask Roadshow Newcastle and you can come join me in person. Otherwise, in Sydney, early next month. So come along to that too. And another wonderful lineup of guests and speakers next month on the 3rd of October. It's a Tuesday night. It's a school night. So come along, UNSW. So Rob's joined us behind the keyboard. If you're watching this on Selfwealth, g'day. If you're watching this on the ASA, the Australian Shareholders Association Network, g'day. If you're on Rask, hello. And if you're on Twitter, LinkedIn, wherever you get your Rask Live every week on a Wednesday. Thank you so much for joining us. The Rask Live program is now in its second installment and brought to you by Selfwealth, of course, but it's been going for a long time. So if you are a veteran of this circuit, thank you so much for joining us during the day. I know it's hard to get here during the day for some folks, particularly if you're on the East Coast, on the West Coast or in Adelaide. So we really do appreciate you taking the time out. I do apologize also for being slightly early. I'm normally 7 minutes late, and so you're probably get an extra 2 or 3 minutes with me today. I'm sorry about that. I was very humbled not too long ago to be asked to speak the upcoming South by Southwest conference, which for those of you that don't know, it's probably the world's leading conference for people who are interested in things like design, creative arts, music, and technology. So it's like a blend of those things. And I was lucky enough to be, I am lucky enough to be hosting a panel there next month. So that's why I'm a bit late. I was just running through some prep on that with some of the team behind it, the wonderful team that will be presenting with me. So Frank, g'day, Benny, hello, Deepak, everyone, Jaden, thank you for joining us for this session. In today's session, what we'll be covering is something that I think will probably be the most impactful for, at least in recent memory, for anyone that is either new to investing or extremely experienced. And I'm going to give away basically all of my secret sauce as it relates to ETF investing. So if you are wanting to build a core portfolio out of ETFs, this is the live show that you want to watch. But I want to stress a few things, as you saw in the disclaimer at the top of the show, and maybe Rob drops in for the Selfwealth channel, or you'll see in a minute in the ticker below. It's really important to remember that any of the information that I offer today is strictly limited to general financial advice only. Now, the reason that I'm saying that is we're going to be talking about ETFs, and I'm going to be talking about things like risk profiles, which is a very sensitive word for me in the finance industry. I don't know your risk profile. I don't know your risk tolerance. I don't know your objectives in life. For example, you might be like me and you might want to buy a farm in 5 years. You might not be like that. You might want to rent or live in an apartment in 2 years. You might want to sell your houses. You might want to go overseas. You might want to not do any of those things. And I just don't know that. So if you do want that type of advice where you can build a portfolio that structures for you, you'd see a licensed and trusted financial planner, which you can get in the Money Smart website. You just go to moneysmart.gov.au and there's a financial advice register there. And it actually shows you, you can search by name or by number or by whatever, And it actually shows you licensed advisors and what they're qualified to give advice on, which is really important too. So I can get rid of that disclaimer down the bottom there because we've probably all had enough of that. I'm going to share my screen as usual. And the way we normally start is with a very lovely reminder to subscribe. Wherever you get this, subscribe. I know the team at Selfwealth, Jason McIntosh is putting on some trading stuff over on the Selfwealth YouTube channel. ASA is publishing podcasts and interviews. And of course, at Rask, we publish a video just about every minute of every day these days. So, so you can subscribe on YouTube. If you're watching this elsewhere, if you're on Facebook, for example, you can follow along there. Okay, so my joke for this week, I realized I didn't put this into the very first Rask Live. My joke for this week is my cell phone accidentally took a 10-minute video of my shoes yesterday. It was some pretty good footage. Now, that's obviously my joke. How did I do out of 10? I'm actually going to take my shoe off and show you something. So I bought these shoes the other day, some white runners, just a bit more casual, if you don't mind. And they were brand new. And I had a bit of what I would say is an incident on the road. Someone tried to stand on my shoes because they thought my shoes were too white. And they're Calvin Klein shoes. But I can assure you they're not expensive because when I was, I would never normally buy shoes like this. But when I was walking past one of the stores at the factory outlet in Melbourne, these shoes were from $160 down to $59. And I just thought, well, that's the value investor in me just has to get a pair of those to put on my feet. And sure enough, I did. The only thing that I regret is I didn't buy more of them because that was a bargain for me. And I was very, very happy with it. So Clinton said, that's a perfect dad joke over on Facebook. Thanks for joining us. So my first Rask Live experience, says Jayesh, welcome. Finally alive at a decent time, says Sneezy, Sneezy Sneeve. I like that one. Laughs. That's 11 for you, mate. Thank you so much, Benny. 9. So once again, there was a bit of confusion last week. If you are watching this, you may be watching it on ASA or on YouTube or on Selfwealth or whatever. So if I do respond to some comments, you know that they're all real. I'm not just making this up and just looking at someone behind the computer here, just pretending that there's someone else in the room with me. So in the next few weeks, we've got some fantastic guests and topics coming up. So obviously today we're talking about the top 5 ETFs in Australia. We will have Drew Meredith, who otherwise goes by Dr. Andrew Dermuth, as it's meant to say, not CFP, it's meant to say Esquire, like this. He'll be up next month. We've got some foolish stocks with Scott Phillips. So this one here is next week, I believe, off the top of my head. I believe it's next week. That's with Scott. So many of you will know Scott from the Motley Fool. And then there'll be a bit of an Ask Me Anything, and that will be on October 4th. But this one here in particular, just so you know, is also next Wednesday at 12 midday with Scott. And you can come along and ask him any question you like on these stocks and just drill into him about what's going on in the economy or whatever, how he invests, these types of things. It's a real treat to have someone of his stature on the show. I'm not just saying that because he's taller than me, but because he also is a really, really good thinker about investing. So good morning, Ben. Good morning to you. It's afternoon where I am, but good morning to you. It's morning where you are. And we're going to have some really fantastic speakers come up on the series over the next couple of months. The likes of Mel Brown, if you know her, Amy Lenardi, so many great speakers, Brian Feroldi, Kate's going to join us soon as well. And the reason that this one has to be at midday next week, just quickly, is because I'll be on the road in Wangaratta in Victoria next week doing another event, our 9th event, 9 out of 10. So we'll be on the home stretch by then. If you haven't already been to a Rask Roadshow, come along. They're $40 a ticket. It's basically free by the time you get all the prizes and merchandise and books and that sort of stuff. So come along, Rask Roadshow, just Google it and you can get some tickets. So today we're going to be talking about these ETFs. So I see Rob's just chimed in with something on Selfwealth there. Feeding in while also in meetings. I give that joke a 9 out of 10. Thanks, Rob. Thank you. That's actually pretty good from you, Rob. I do appreciate that. So today we're going to be talking about ETFs in particular. There are over 300 ETFs in Australia, 2,500 or about 2,800, depending on the number you look at in the USA. And of course, through Selfwealth, for example, you can invest not just in Australian ETFs, like on the ASX, but you can also invest in US ETFs. But what I've done for today's show is I'm just focusing on Australian listed ETFs, and in particular ASX listed. A lot of people don't know this, but there's actually more than one stock exchange in Australia, just so you know. It's just that the one that most of us do anything on is the ASX. But there are a few others, actually. The biggest one as an alternative would be CBOE, and another one is the NSX, the National Stock Exchange. So there's all these different stock exchanges. It's just in Australia, we tend to say ASX because it sounds like it says Australian Stock Exchange, and it sounds like the right one, and it is the biggest. In the United States, you've got the NASDAQ, you've got the New York Stock Exchange, etc. But I'm only focusing on the 300 that are here in Australia, and I'm going to show you how you don't even need 300 to build what I would say is a diversified portfolio. So maybe the financial planners or the professional investors who are my peers might have a bit of a sour taste in their mouth after they watch this show, because I'm going to show you how you can put the building blocks together in a portfolio. Now, again, I don't know your personal circumstances. This is strictly general in nature. I want to be really clear with this session today. But as you know, this is the second Rask Live, and I want you to be able to go back in 10 years and go, on September 20th, 2023, I was watching this guy called Owen Rask, and he told me how to build this portfolio. I followed the general principles, and I applied it for my own life, and I spoke to my advisor, or whatever you did, and you look back and you say, that was a really good decision. That was a really good hour that I spent with him and the community to learn about this way of investing. So I'm going to use ETFs. Most of you know what that is. For those of you that don't know what an ETF is, an exchange traded fund, it is just a basket of shares for just anyone that needs to be filled in on this. I'll just get up, see if it's in my library here. So an analogy might be that an ETF is like a bunch of flowers. You can either buy roses, lilies, all that separately. Or you can buy the basket, which is just an ETF. So the ETF might include all of Australian shares or all of US shares or even bonds. You can even get cash inside of ETF. And the point is that you can get exposure to all of those different flowers in one investment rather than picking each individual one. So that's kind of the elementary stuff. We have done sessions on that before. Exchange traded fund. So within an ETF, the thing that makes ETFs really special is you can, once you have decided that you want to use ETFs, instead of picking which shares or whatever you want to buy, what you can do is you can just say, well, I want some shares, some cash. I want developed markets, simply would mean like Australia, USA, most Western countries, etc. So that might be like all of USA and Australia in there. And I might want some Chinese shares in there. But the difference is there is a basket for each of these things. And there are multiple baskets you can get for different types of exposures. But the point is, if you wanted to just invest in shares, you can do that with one ETF. You don't need to pick which shares to buy. Same with bonds. You don't need to be an expert in bonds. And that's really important for the 99% of us on this call who don't know what bonds are exactly. You might have a general idea, but you don't know exactly what they are. I'm going to explain to you what they are. And why they are really interesting to me right now. It's the single most important. This thing right here is the single most important that me and the team at Rask, the analyst team at Rask, are spending our time on. It is the number one decision. Do we invest in bonds right now? How much do we invest? And which ways do we go about it? And I'm going to explain how we think about that. So the idea of this chart is that you can look at it and you can see basically where the different types of investments would sit, both on the expected return, which is up here, and the expected risk. So obviously the things up this end, like Chinese shares in particular, they're a type of emerging market shares, or Indian shares, they're going to be more risky. And when we say risky, that means more ups and downs in the share price, right? Whereas say cash, which is right down this end, you know what you're getting if it's in a government-backed account. It just looks like a flat line. There's not as much variability or risk in that. So the key question is, okay, now that we know that there's some things that are less risky and then it gets more risky as we go on, the question is then, how do we put them all together? And that's typically defined in something called a risk profile. So a financial advisor would sit down with you and they would say something like, okay, Mr. Johnson, we think you are a conservative investor because you said you're really worried about losing money, and that is the only thing you're worried about. But then you might get Mr. Owen Rask come in, and the financial advisor says, okay, based on our modeling of your risk profile and the questions that you answered, Mr. Rask, we think you are a growth-focused investor. You have a high risk tolerance. And therefore, we're going to invest more in growing assets and less in the defensive assets. So we call these, typically in academic history, what we call these is like a mixture of stocks and bonds, because in the past, basically all you had available was stocks and bonds. There's a bit more than that today. But if we go back into our chart, it's basically how do we mix this with this? So how do we mix these two together? And that gives us a representation of our risk profile. So I'm going to show you how to do that. But obviously there are more options outside of this. So it's not as simple as like some shares, some bonds these days. Now we have a few other things to think about. But basically, the shorter your time horizon, if we go like this, the shorter your time horizon, the more risk, the less risk you want to take. So the more security you want. Because if you think about it, if you're going to need the money in the next 3 years, you don't want to be investing that money. You want to keep it in cash. But because you're not, then the reason is because you're not going to be susceptible to the stock market falling. But if you were to put all of that in the stock market and the stock market fell 30%, that would be what happens. So g'day, Robert. Great show last night in Port Macquarie. Thanks, Robert. Thank you. It was a small group of us, but it was actually so much fun, and it was the smallest of the road shows that we did last night. So I just loved the chances to sit down and chat. Colin, you've said when buying ETFs, make sure you buy ETFs in Australia. Otherwise, you need to fill out tax docs. Yeah. So Colin, that's a great point. So with an ETF, all of the ETFs that I mentioned today have a, get that out of the way. They have something called tax domicile. I'll just blow this up a bit for all of us. So tax domicile basically refers to where is that ETF located for tax reasons. Now, everyone on this will probably want to be looking at Australia, meaning that if you own an ETF that is an Australian ETF for tax purposes, it's like if you have to fill out that form that you get for income. Are you an Australian tax resident? Yes, I am. In this instance, you want to have this because if it says, for example, USA or UK or something like that, what that means is you've got to fill out something called the W8, I think it's W8 Ben form. Now, if you've ever filled one of those out, they're okay. But if you have a self-managed super fund and you get one of these, they're even uglier. So W8 Ben E form, which is even uglier again. So all of the ETFs that I'm mentioning tonight are Australia. The way to check this is just to read the product disclosure statement or the PDS, but I've done that work for you. I'm not going to mention ETFs that are not in Australia for tax reasons. If you invest via your Selfwealth account, not that one. If you invest, we'll go here. If you invest via your Selfwealth account and you find an ETF that's not on the Australian Stock Exchange, for example, SPY. So in this instance, this ETF has an American flag next to it. This would be a US ETF for tax reasons. But for example, this ETF here could be either. It could be a US or it could be an Australian. I know from reading the product disclosure statement that this is an Australian one. This is really, it can get quite confusing for people because people will be like, well, it's an Australian ETF. Why isn't it Australian for tax? Because it's cheaper for some of the big ETF providers not to do that. The most common example of a US tax domicile ETF is this one from Vanguard, the VTS ETF. It's really low cost. It's really popular, but you'll have to fill out the tax form. Anyway, yeah, so Penny, you made a good example here. I got stung with an unexpected W8 Ben form for my SMSF when buying ResMed shares recently. Painful, yeah. See, ResMed is a good example. So ResMed on the Australian Stock Exchange. This is an Australian. It's on the Australian Stock Exchange because it says ASX there, but it's actually a US company, and you know that because it actually says CDI, but it's actually a US company. So you end up paying that silly form as well. Anyway, okay, so we know that basically based on this, we know that there are different types of risk profiles and they're kind of answered with a questionnaire. So a financial advisor would basically sit down and say, where do you sit on this spectrum? Some couples, for example, might have someone who is growth and someone who is conservative, and the advisor might be like, well, you should be balanced for your combined portfolio, or maybe the financial advisor builds two separate portfolios for them. And basically what happens underneath is there's a different combination of risky assets to not as risky assets. They still have some risk, but they're not as risky. Cash would be a good example of what goes in each part. So if I say 50-50 for the rest of this show, what I mean is it's 50% in defensive or growth and 50% in defensive. So 50% in defensive, 50% in growth. That's what we call 50-50 portfolio. If I said 70-30, what I mean is 70% in growth, 30% in defensive. We're going to build a balanced portfolio today here, which would be something like this, right? So we'll keep moving on. By the way, this thing down the bottom here, this financial knowledge thing, as far as I'm aware, I haven't come across financial research that shows that your level of financial knowledge is actually important to your risk profile. But if you think about that for a second, if you have a high level of understanding about how the share market works, I believe that you can afford to take more risk. So, for example, I think Warren Buffett can afford to take more risk than a 7-year-old that's never even understood the concept of money, because Warren Buffett would know the risks involved. So therefore, he would have a higher risk tolerance just because he knows more. I just want to make that point clear. It's also a learning process. Made it to your first live session, says Benjamin Fox. Thanks, Benjamin. This is great. Thank you so much. It's great to hear that so many people can make it during the day. Okay, so I've got a question for you. I'm going to show you this portfolio here. And this is a hypothetical question. These are the ETFs that will be revealed in the next little while. I'm curious. I actually think I've made a mistake, but that's okay. I'm going to reveal the different ETFs and what they do, but I'm curious, just based on what you can see on this page, just the colors alone, and you might be able to see the percentages if you look really closely at the screen, does it seem like this might be a diversified portfolio? And I'll give you a hint. Almost all of these different colors represent a different part of this. So based on this one and only piece of information about the pie chart, does it look like a diversified portfolio? Does it look like a diversified portfolio? And I'll see, just answer some questions while you guys are doing that. James said, I think a rule of thumb was to have your age in percentage in bonds. James, that's a great comment. I'll get back to that in a moment. Ben, you've said, maybe asking a bit prematurely, but are the Terra, Martian, Jupiter core portfolios being updated soon? Or are these going away to portfolios? Ben, this is a very, very good question. It's a little bit premature, not going to lie, but basically just so people know, at Rask, I've designed 3 portfolios for our community. One's called Terra, one's called Martian, and one's called Jupiter, because I'm fascinated by space, obviously. Terra is 50-50, Martian will be 70-30, and Jupiter is 90-10, meaning that there are 90% in the growth and 10% in defensive. Ben, I'm not really at liberty. I'm in a bit of a sticky situation, Ben, because I'm working on something behind the scenes at Rask, but I don't have all of the legal documents to tell you all about it right now. But I will in about 2 or 3 weeks. But in short, we are going to make some changes, small changes to the portfolios. There will be small tweaks based on what I'm about to talk about in this live show. Feels like a trick question. Definitely not a trick question. So does it look diversified? Ben said, looks diversified, but could be deceiving. Colin said, yes. Deepak, yes. Vinicius, yes. It's 100% diversified. Jupiter, long-term investor. Jupiter is also my chosen strategy. Okay. Potentially concentrated with 2 positions of 25%, says Tarwin. Potentially. Yeah, so Ben, I won't be able to tell you more, and I'll be able to tell the entire Rask community probably in about 2 or 3 weeks. Chris, you said looks diversified, bearing crossover. Great point. Okay, so this portfolio represents a few things. Now, if you read the email that was sent out, you will know that I've kind of covered some of my favorite ETFs already. So I will reveal them and touch on why they are really interesting. So let's talk about this first ETF. So I'm trying to build a portfolio out of 7 ETFs. Obviously, you could use more if you wanted to. I don't think in Australia to build the core portfolio, which is, the big bit in the middle, to build the core portfolio and then to have your satellites around the outside, maybe like individual shares or thematic ETFs. For the core, I don't think most people need more than 10 ETFs because you're diversified by using these good ETFs anyway. So for me, you don't need more than 10. That said, if someone presented to me and they're like, "Hey, Owen, I've got 12," well, I'm not going to, it's not, it's not a big deal as long as they're put together, as Crisp said before, as long as they're put together. When can we expect the Rask ETF, says Lachlan? Not 100% sure about that, mate, but yeah, I can tell you how much it costs to do an ETF in Australia. It's about, I would say conservatively, about $300,000 for the first year. And I tell you what, it's not the kind of scratch I just have available to throw at an ETF. So I wish it did, but yeah, it's not. Another thing that's a problem with ETFs from someone like my perspective, Lachlan, if I wanted to build my own ETF and offer it to the market, is that with an ETF, for it to be called an ETF, I can't be making decisions on what's inside it because then it's not an ETF anymore, right? It's not like a set and forget style strategy. It's a actively managed fund, which makes it a bit more complicated because you can't use the word or the acronym ETF. Anyway, so cash. This is the most defensive asset that you can get, basically. This ETF, which is from Beta Shares, the AAA ETF, I'll get it up inside Selfwealth so you see what I'm talking about. This ETF is an ETF that basically just takes your money and it puts it into bank accounts that pay interest. And that's why you end up with this chart when it loads in just a second. Is it coming? Are you coming? Let's have a look. Oh, there we go. It came right at the end. So this chart kind of looks like a shark tooth, right? Like you've got kind of up and down, up and down, up and down. And basically what's happening here is the ETF puts money in a bank account, then it comes up, and then it falls again. So what's it doing? Well, if you look at the chart axes on the right here, they're very small numbers, but basically what it's suggesting is that every month the ETF accrues interest and then pays it out. Accrues interest, then pays it out. Accrues interest, then pays it out. So let's go to 12-year price on the ETF. And here we can see basically it following interest rates down and then coming back with interest rates up. And that's because the ETF can only offer interest rates that it can get from a bank account, right? So that's what we see there. So basically what I mean to say is this ETF as a general rule is used as kind of like a backstop in portfolios. It gives you flexibility in the future while still earning interest. So here's a good question from Ben. Ben, you've said, why choose AAA, the cash ETF from Beta Shares, versus savings in a savings account like ING or Ubank, for example, you can get 5.25%. So in a portfolio of this, Benjamin, like this, I wanted to stress the point that you can use ETFs to do this. And in fact, we use this ETF for our model portfolios. And the reason is that not everyone wants to step outside their brokerage account. They kind of like want it all in one place. But if I was to tell you, if I had cash, like all of my personal cash that I have that's not investing in my account, what I do with that is I would actually put that, oh, I'm sorry, 1 second. Oh, sorry, 1 second. Thank you. Sorry, guys. I just had the housekeeping coming. I should have put the do not disturb on the door. So with this, in particular with this ETF, what we use it for is basically to use buying power, have buying power in the future. And I have it in my portfolio so that it's ready to use there and then, and I get the interest. But if I have a mortgage, what I would do is I would use, I'm going to try and write this with the pad, but I would use my offset account. That's not going to work. Offset, no, I'm not going to do it. So I'm going to get the actual little text box out. So here we go. I am going to go like this. So in order of what I would do with my cash right now, one, offset account, which is obviously only available for mortgages, savings accounts, and rolling term deposits. Deposits like this, and we'll go like this, and it's not working. And then three is I would use AAA. So let me just bring this up. I'm going to load this up so we can all see it a bit. But this is basically the order of which I would use the cash that I have available. So I would put money in an offset account first and foremost because it pays the most after-tax interest, even though it doesn't pay it, so to speak. Then I would consider using savings accounts and term deposits. But interestingly, what I would do with term deposits, and this is only me generally speaking, of course, is I wouldn't put it all in one term deposit. I think that's what a lot of people make a mistake with. They just put all their cash in one term deposit, and then they think, oh, geez, actually, I need that money. I'm going to have to break the term deposit and lose the interest. So what you do is you stagger the ETFs. Stagger the term deposits. I just saw the comment from Penny. You stagger the term deposits so that you might have one for 6 months, one for 12 months, one for 2 years, one for 5 years, and stuff like that. And the reason you would use a term deposit over a savings account is a term deposit should offer you a little bit more, and you can lock in the interest rate. So if you're a retiree, for example, you might think, well, 5% interest rates on a term deposit, that's all I need. That's all I need from my money. Why don't I just use a term deposit? There's no risk involved. Well, if that's the way you think, then rolling term deposits makes sense. Jimmy, you said you've got all of yours in an offset account, and so do I. And finally, we have AAA. AAA is an ETF that basically allows you to get exposure. And the benefit of AAA, and the reason we use it, is so that the money is almost instantly available. So if, for example, you want to take this amount of money and you put it in here, you'll see in a minute what that is, then you can do that really quickly. It's all in the same bank account. Not that, speed is always the number one priority, but it's a stabilizer. This is a stabilizer in your portfolio that also pays you interest. Okay, moving on. Number 2, ETF number 2. And by the way, this is the biggest ETF in the country for that style. Number 2 is the gold ETF from GlobalX. Now I'm gonna twist my words a bit here. And we've had this debate both here on the live show over the years, but also on our podcasts at Rask. Do you need gold in the portfolio? The answer is no. The answer is you do not need gold in a portfolio. It doesn't matter what anyone says, you do not need it. It's just whether or not you want it in your portfolio. And I think that's really important to remember. You do not need it. It's if you want it. And the way gold works as an investment is that people use it, and investors and professional investors, huge institutions, really professional, good investors use it. So I'm not discrediting it. It's a choice you can make. Some people say yes, some people say no. Like Warren Buffett is a very firm no, for example. But it doesn't pay any income. But what it actually does is it also acts like a stabilizer. So some people say that this should be included in the defensive side of a portfolio. On that 50-50, it would be on the defensive side. But it's also not a great idea to have a lot of gold because it doesn't pay income. However, when would you consider hedging your gold ETF? I'll show you, Tarwin. Currency hedging. I created a chart not too long ago on our website because I know a lot of people don't have access to like really complicated tools. And I'll just pop this in the chat. So this will say currency hedging in the chat if you're receiving this. I'm about 5 seconds ahead of you. But what this chart basically shows is it shows the Australian dollar to US dollar over time, and it shows basically the long-term average and a what we call standard deviation. So basically a range. So if I zoom in a bit here, what we can see in this black line and with the shaded area is the actual currency right now. So it's 64 cents, say. And then the green lines show you standard deviations. So like the range that it typically moves in. Now, there are a few different ways to think about currency hedging. People do it because they're worried the Australian dollar is really low and it might rise again. And if that's the case, if you invest overseas, like in gold in the United States, for example, you're going to lose some purchasing power simply because of the currency. So there are a few different ways people do this, Tarwin. I can only speak generally, of course. But the way people tend to do it as professionals is they make one of 3 choices. Number 1, if they have gold in their portfolio, just as an example, they'll simply do this. Oh, that's not right. They'll simply just split it down the middle. The second thing that they might do is they might take a view and they might say, so when I say split it down the middle, they have half currency hedged and half unhedged. Now, the currency hedged version in Australia is QAU, this ETF. It's basically the same type of ETF as the gold ETF from GlobalX, except this one's currency hedged. There are fees and things. Read the product disclosure statement, please. But basically, that's an option. Then the other option is trying to predict the currency. So in this case, you might say, by looking at this chart, and the reason I brought this up is that, like, some financial planners, for example, my esteemed podcast co-host Drew Meredith uses this rule. When the currency gets to a point where it's at a point where it might be at the low end of the standard deviation, so like right here, it's nearly touching that green line, they would then seek to use currency hedged ETFs. And then when it goes back up, they would maybe seek to use unhedged. Now, it's really important to understand that that's just a general rule. And in Drew's case, he's building portfolios for retirees at Waddle Partners, right? So he's using a retiree's portfolio. But as an accumulator like myself, if I sell an investment, I'm going to pay tax, whereas some of his clients wouldn't pay tax in the retirement phase. So you can't just flip it back and forth. Like you pay tax and there's trading costs. The other strategy for currency is to actually just take your entire portfolio and decide how much of the entire portfolio do I want exposed to one currency. And so the answer is to this question, we could do a whole episode about this, Tarwin, but I just wanted to make it clear, is that you can just keep it as simple as you like. There's no exact science for a lot of this stuff. So Clinton, you made a good point over on Facebook. You said, I currently hold gold and silver as a physical asset, so I would probably look at giving this one a miss. Yeah, and so this is the idea of today's show, is to just showcase what it can look like. So this is not necessarily right for anyone or everyone. Okay, so we've got AAA and we've got gold. Both of these are ETFs. This is commodities, and this is just cash. Cash obviously pays income. This, so that would be a plus. This does not pay income. But gold is typically used in a portfolio where people believe that there is uncertainty in the world. So things like geopolitical events, the Ukraine war, higher inflation, they typically look to gold as a stabilizer in their portfolio. And statistically, that makes sense. But as I said, a lot of people don't use it. For example, I don't really use gold other than the portfolios that we create. Like, I don't own gold. I have some gold jewelry that's been sitting in my safe at home for a very long time, but that's about it. Okay, so if we move on to the third position. Now, some people did say that there was a big difference and there's a big allocation to this one thing, which is VAS from Vanguard. This is the biggest ETF in the country. There is no if, buts, or maybes. It is the biggest ETF Australia has ever seen. I'm going to show you something. I've showed a few of you this before, but you can actually download a list of the, I guess, what do you call it? The most popular ETFs every month. There's a report that comes out from the ASX that shows you ETFs. It shows you managed funds on the market. It shows you REITs, LICs, all of those wonderful acronyms that y'all love. Well, we don't love, we just kind of have to put up with. But I'm actually going to get up something else in a different tab here while I do this, because if I showed you in the actual tab, I might give away some trade secrets. And I'm going to drag it across. Okay. So when I created today's list, what I actually looked at, and you can see that now, is I actually showed you a version of the ASX report. And what it shows you here is it shows you the biggest ETFs in the country. I'll zoom in a bit. It actually shows you the biggest ETFs in the country based on their size, or like the amount of money that's inside them. And the Vanguard ETF is at the top here with $12.9 billion. The next closest ETF or fund is the Magellan Fund at 6.8 billion. That's a big, long way down. After that, you've got the VGS ETF, which is always amongst the most popular traded inside Selfwealth. And in fifth, you've got the IVV ETF. Deepak, you've asked a good question. Instead of buying 5 to 7 ETFs that you cover everything, what's your thoughts on investing in something like, say, VDGR or VDHG? That way you don't have to worry about rebalancing. I'll get to that in just a second. Deepak. Good question. So you're talking about is an ETF that's actually further down, and it's an ETF of ETFs. Let's just call it that, even though it's technically not correct. It's an ETF of ETF. There it is there. I expect these to get more popular in the future. I actually did an interview with Vanguard not too long ago. If you're watching this on the Rask channel, sorry, I don't know where you're watching from, Deepak, but over on the Rask channel, there's an interview with basically the boss of Vanguard. I'll call him the boss. And he talked about the changes that they might make to the VDHG and those types of ETFs soon. Anyway, So anyone can download this and you can get a list of what's popular. You can also see the fees. MER just stands for management expense ratio, basically the fees you pay. You can see how many shares were traded, the performance, and importantly, when you look at the performance here, this is total return. So this is the total return, meaning income and growth. Most ETFs providers won't show you, or the share price that you see does not include income, obviously. Okay, so back to my chart. So we've got VAS. VAS includes 300 shares. So it's the ASX 300, not just the 200. Now, people present to me as if I was some sort of qualified financial doctor, and they say, Owen, I own the A200 ETF from BetaShares, or they say, I own STW, or I own IOZ, or I own whatever. And I say, that's great. It doesn't really matter which one you own because they all basically do the same thing. Now, I've chosen VAS because I do like the ASX 300 more so than the ASX 200, even though history might suggest that maybe the 200 is a better index to follow. With the VAS ETF, it's obviously got Vanguard behind it, and you've got the economies of scale. So now that it's the biggest ETF, it's slowly able to drop its costs, much like BetaShares dropping their costs too. They're all kind of dropping their costs over time. But the most important thing is not necessarily which one you pick. It's about just having one of them. And almost every academic study on long-term investing shows that. It's not necessarily about which one you go with. It's just about being invested. Oh, yes. Could you share a link to that ASX report? Yes, I can. You can download it in PDF, or you can download it in Excel form or CSV form, Jayesh. So there you go. And there you have. Penny, you've said, agree with Daniel. I use high interest savings accounts for my personal cash. I use AAA for my SMSF, as can't get high interest in my bank accounts. Yeah, that's a good way to do it. So Daniel, you said, bonds seem like a very defensive strategy for uncertain times. Yes, I will get to that in a second. Send It Sunday says, do gold ETFs invest in physical gold or gold stocks? Rask Live. Send It Sundays. So there is another report that I've done. I don't want to keep talking about my own stuff. It's bad form, but I actually did a report not too long ago on the best gold ETFs in the country. This one right here, I think that's this one is the updated one. So I'm just going to drop this in the chat, gold ETFs, rather than just me take another tangent. But in short, there are some ETFs in Australia that look like gold ETFs that aren't actual gold ETFs. They're gold mining ETFs, like these two right here. They just invest in mining shares. So gold mining companies, that's what they own. They don't own the gold bars. But there are a few ETFs that just own the gold bars. And they're like the GOLD ETF, which I just mentioned, the QAU ETF, and the new one, NUG, from Van Eck, which is NUGG. So the ones that I prefer are the physical gold ETFs, like GOLD. It has to say that in the name, by the way. So VAS 300, the reason I would put, you don't have to use one ETF, you could use different ETF. The idea was just to show you that a lot of Australian investors want some exposure to Australian shares, and this is it right here, even if they're in retirement, because with Australian shares, you get franking credits, you get dividends, and you get some growth over the long term. So moving on, we've got the next part of the portfolio, and this is where I might have made the mistake. So you'll have to forgive me in just a second. But because I said I was creating a 50-50 portfolio. So here what we can see is IVV. IVV is the S&P 500 ETF, here at number 4 on the list. This ETF just simply invests in the top 500 shares. So IVV ETF, if I bring this up. So this ETF here, I'll explain it. It's a little bit different, and it actually loops back into something that we had before. But if you go down on this page, you can obviously read the product disclosure statements and all of that sort of stuff. I would love it if you go and read the product disclosure statement of every ETF. I mean, you should read it before you invest, at least like the major parts of the PDS. Anyway, inside the ETF, you can see what the individual shares are. But a lot of people get confused with this ETF because when they look at it, they sometimes see something different. Now, I'm going to try and find it. I can't actually see where it is right now. But sometimes when they look at this ETF, they get a bit, I'm looking at the US one. That's why. Here we go. This is the one we want. Now, sometimes when people look at this ETF, what they actually see is they see this and they're like, well, that doesn't make any sense. Owen said it had like Apple and stuff in it. And you have to click on this underlying holdings thing to see that. Now, so what this ETF actually does, if you notice, 99.98% of it is actually invested in this thing, this other thing. And that's because that's the ETF that I just clicked on. It's the US version. So basically all the IVV ETF does is I'm going to try and write it again. If we've got IVV, which is an Australia tax domiciled fund. So if we go to tax, no, it doesn't have it here. Sometimes I'll say it on the page. Domicile. No, they don't have it. This is an Australian taxed ETF. But what it basically does is it just takes the money and then invests it in a US version of itself. That's all it does, right? And then from there, it invests in the 500 companies. So that's basically how you end up investing. And this is perfectly normal. We call this a feeder fund, meaning it feeds into the master fund and then it invests in the stuff. The benefit of this structure, this is what Vanguard should do, in my opinion, with their VTS ETF, is because the W8 Ben form is filled out between these two steps. Basically, it's filled out here and basically says that there's an Australian fund that just invests in the US fund. So we only need to fill out one form for everyone in the investment. So Penny says loves it. So Tarwin, you've asked a good question. Drew seems to be a big fan of MVW rather than VAS. Is accumulated versus retiree thing too? Yes. So in here, you can also use the MVW ETF, which has just 100 equal weighted. That's a terrible M. That's a terrible V, but there's a W for you. MVW. And we'll see that here inside Selfwealth. Just really quickly. This is just 100 shares from Australia, and all of them are equally weighted. So around about 1% each. Whereas inside VAS, the VAS ETF, you're going to get a bit of skew to the biggest companies have more of the holding. So anyway, I don't think there's a problem with MVW per se. Would I use it? It's not my preferred choice. Different people will use MVW for different reasons, but one of the reasons you might use MVW and only have 100 of the biggest shares is if your client, and you're a financial planner like say Drew is, your client might already own some shares. And in that case, you don't want to go and get all 300 again. You might just want to be a bit more focused on a certain few things. Okay, next one, and this is where I made a mistake. So I'm going to adjust my holdings here. Actually, I'll just do it for the last one. You guys will get the idea of it in just a sec. So just know that it's not 10%. I won't be doing that. So here we can see the Qual ETF. Now I explained this in email form, but what is the Qual ETF? So the Qual ETF, as it says on the tin, it says the MSCI International Quality ETF. This is in Australia the biggest factor ETF. So I'll just switch off the screen for a second. So what is a factor ETF? A factor ETF is basically built on academic theory. Don't let that scare you. It's not that complicated. It's built on this theory that some companies have certain tendencies that you might want to invest in or exploit. So a good one of those is the quality factor. So what basically makes a high quality company? You might say things like, well, it's probably got a pretty good product. It's probably got good customer service. It's probably got, good profits. It's probably good for the environment. That might be your definition of quality, right? In the financial sector, what we mean by quality is like the quality of the business and its financials. So we might say things like it doesn't have that much debt. It's got a good profitability, a return on equity, and its profits are pretty stable. It doesn't record that many losses, even though, from each year to the next, it's pretty stable. And so that's what we would say is quality. And that's exactly what this ETF does. Instead of just buying all of the shares in the stock market, it just buys the quality shares based on those three rules. And so it has grown, I'll say individual investor, so we get the full experience. And basically all it does is it goes out and it buys companies that it says are high quality. It buys about 300 of them and it puts it in the portfolio. There's about 302 there right now. And so I'll give you example of where you can find the product disclosure statement on this website. You can just go to documents and you can see product disclosure statement is, here we go. PDS is available here, and it has all the information on how it creates the portfolio. If you go into the PDS, it will explain how it happens. Sometimes you'll see product disclosure statements like this, where it bundles a few different ETFs into one product disclosure statement, or in this case, many, because they're all basically the same except what they invest in. Okay, so the Qual ETF invests in international shares. So in reality, the color of this should not be blue. It should look more like this. Maybe not that. Maybe we'll go this. So if we were comparing colors, it's basically the same part of the portfolio as this. So from here right around to there, these two right here are basically investing in the same thing. So CRISP was right earlier on when they commented in the chat and said you have to be careful of overlap. And that's because some of the companies that are in Qual are also in IVV. So here we can see, if we zoom out a bit and we go back, here we can see names like Apple, Microsoft, even NVIDIA, Visa, Alphabet, or Google. All of those were also in IVV. So in this instance, you don't add them separately. You think of them as one because there's so much overlap. Now, for me, this is why I wanted to include Qual as an example of how you could use this. But for me, in a core portfolio, I'll just get rid of all this red text. I would take this chunk and I would remove it, and I would make that a satellite holding around the outside. And it might be like 3, 4, or 5%. But I just wanted to give you an example of how it could go in there. Now, I'll keep going because I'll keep going. So, Taiwan, you said Qual and IVV have stock overlaps, e.g. Apple. How do you think about total exposure in one holding? So that's, Anthony, Taiwan, you're on the ball there. So basically just what I just said is I think of them as one holding because they're basically getting me the same thing. Even though IVV has 500 and Qual has 300 from around the world, a lot of Qual is invested in the United States anyway. So you get a bit of this other stuff from other markets where with IVV, you only get the US shares, but you basically end up, it's a slight diversifier because it gets you some international shares, but in reality, it's basically the same thing and it costs more. So I prefer IVV in the core, Qual in a satellite holding as an option. So now let's talk about the next thing. The only thing that's missing is bonds, and we're going to talk about that really quickly. I want to quickly mention something, however, and remember, these aren't in balance. So we're going to get rid of this and we'll probably adjust each of these down. I was doing them a bit blind before. But in a normal portfolio, another way I was going to show you this pie chart is basically like building blocks. So in a portfolio, typically you have things that are more important than other things in a portfolio, right? Things that need to be down the bottom and need to be there first. And for me, that's cash, right? Like cash has to be the most important part of anyone's wealth because you need it, because you can access it, you can buy things with it, you can invest it, you can spend it, you can do whatever. But that is like the bedrock. That's the number one thing that goes down. Alongside that, you want to have stocks and you want to have bonds. Those three things, you can build a great portfolio. Stocks, bonds, and cash. Wonderful. That's why all the theory is based on that. But then we can layer other things on top, like we could have gold, you could have different types of bonds, for example, and then you can have more esoteric things that go in your satellite, things like crypto, if you really want to. I don't want it, but if you wanted to, right? But bonds are really, really important to a portfolio. So I said it in the email that hopefully you all received. The email goes out on a Monday or a Tuesday, just so you know. But in a portfolio, bonds should be alongside cash and shares the most important thing that you think about. The problem that we've had in the last few years with bonds is that they've all fallen because remember, bonds move in the opposite direction. I'm about to explain what they are, but just so you remember, bonds move in the opposite direction of interest rates, most bonds. So this is an international bond ETF and this is an Australian bond ETF. And the reason why they've done that is because interest rates have done this. So interest rates have gone up, so bonds have come down. Pretty simple, right? So what is a bond? A bond in this case is just a portfolio. We're going to talk about it as a portfolio level of promises, basically. So a bond, you know the whole saying, my word is my bond. Basically what it means is you lend me money and I promise to pay you back and I owe you. You say, here's $100, Owen, and I say thank you very much. And I'll give you that $100 back in 10 years, but I'll also give you $3 a year as a coupon payment, kind of like a dividend, to reward you for giving me that money now. And so that's what we would do as a bond. And in this instance, instead of it just being me and you, typically what happens is, in this instance, it might be iShares buying the bonds in the secondary market. But typically the way they exist is the government says, we need money to build a road. We're going to issue some bonds. Who wants to give us $100? And then one of the big super funds comes along, like Australian Super, and says, I'll buy some bonds. And then Australian Super gives them $100 and gets the bond, the contract. And the Australian government says, thank you. I'll take that $100 and go and invest it, and I'll repay you $100 and give you $3 each year for the next 10 years. Then Australian Super can take that bond and sell it, just like any other bond. So they're tradable. And this is I think it's the biggest market in the world, or one of the biggest markets in the world. So it's bigger than the stock market and more important, but people just don't really understand it. Anyway, a bond ETF effectively gives you blanketed exposure to the entire market. So in this case, we're getting global bonds. And in the final case, which I'll reveal, let's just go down there now. This is Australian bonds. So these are my two preferred bond ETFs, IAF and VBND. So VBND is number 35 on the list. And IAF, where are you? IAF is number 22. And I'm going to show you something. If we go across, so we know, get rid of all this other junk really quick. We'll go like this. Where did I just put it? IAF here. So if we just focus our attention on this really quick, and we might go about 5 minutes over today, guys. So sorry about that. If we just focus on this column here, what we're looking at is the size of the ETF is around $2 billion. There's $2 billion inside it. But what we saw, what we want to see over time, and it can't really see it here, is the flow into the ETF. So the money going in. And so we can see that there was an extra $14 million at the end of the month. This is in August. And there was 1.8 million actually taken out. So the reason it went up 14 million is because the value of the ETF might have gone up. Now, basically what we will see, and I think what we'll see over time this year and next year, is we'll see more money invested in bonds. And the reason is as follows. Remember how I said before that interest rates have gone up? It doesn't need to be, like, we don't need to be economists all here to know that higher interest rates have hurt a lot of investors and families. A lot of people aren't investing as much. I'm not investing as much because I've got a mortgage, for example. So eventually that has an effect. And eventually we may get to a point where interest rates start to slowly fall, or at least stabilize, which is probably where we're at now. If that's the case, most people would say that bond ETFs might actually start to perform well again, kind of like back before COVID. They might, if interest rates plateau, bonds might actually start to perform well. And this is important because for the first time in the last few years, bonds are actually starting to look attractive. We sold the bond ETF that we held for the Rask portfolio somewhere around here. And it was a good decision, obviously. But basically, bonds now offer a yield of anywhere between 2 and 3%. So these are government bonds, so they're quite defensive, 2 and 3%, kind of like a term deposit. But the difference with a term deposit in this is your money, the value of your investment can also go up and down like this. So if you believed interest rates were going to go down, which is pretty bold to think that, you would have your portfolio in bonds because you would get the interest, but you would also get the value of them increasing. Now, if you think interest rates are going to be flat, well, you might keep your money in a term deposit, and maybe the best option. But if you think interest rates are going to keep going up for whatever reason, you would want to avoid bonds again because you wouldn't want this to happen again. And that's basically the way they work. Now, my opinion is that for the first time in a long time, bonds are actually starting to look really interesting. And so I would have, and I actively am doing this for our community is having some bonds in a portfolio. So let's just recap. And I'm going to go down to this last thing. And I'll go back to my question. I'm going to change this really quickly. And I'm going to ask you the same question I asked you before. We'll go say 25. And we'll say 5. I do want to get rid of why did that not balance. So I've got 10, 10, 10, 5, 5. Oh, I can't get this out of the way. Sorry, guys. So 10, 20, 25, 45. Okay. So in my portfolio, I want to make sure I'm doing the right thing here. If I go back up, let's take this. Why did it not balance? So I'll be with you in just a sec. In my portfolio, why did that go down? Okay, let's get rid of that. Sorry, guys, I'll be with you in just a sec. I'm just going to make sure this is balanced before I ask you the hypothetical question. I need to get rid of that qual allocation because that is too high. I'm going to take that and I'm going to pop that into AAA. Here we go. Okay. So, and I'm going to take 5 away from VAS. Doing this on the fly, which is probably not the greatest thing. We're going to go 15 like that. Okay, so that's more balanced now. My question to you is, do you think this is balanced? I think it is more balanced. So here on one side, we've got the growth side. So this is the 50-50. And then on the other side, we've got the other part of the portfolio. So we've got the defensive side and we've got the growth side, which is riskier. Do you think this is a balanced portfolio is my question. Do you think this is the strategy? Looks diversified, says Benjamin. Okay, so this is a really interesting thing. Now, obviously, this is just an example of like how it could go for a 50-50 portfolio. So in this instance, there are a few questions that you might want to ask yourself. Number one, is that too much in cash? Number two, is this, that's a very bad start, Owen, but you get the point. Do I need gold? Do I need a factor-based ETF inside my portfolio? The other things around like the bonds and that sort of stuff then become a question of, okay, if this is too much cash, where do I put it? Maybe I put it more in bonds. Maybe I put it more in global bonds. Or maybe I put another thing in there. Maybe I find another thing that could go in here. So another thing that could go in here, rather than say government bonds from Australia and government bonds from the USA, you might have like what we call floating rate bonds. So an ETF that does that is QPON. I'm not going to write it out, QPON, which is riskier than cash, but it's often considered a defensive holding. So this, when you see your financial planner, this is the conversation you want to have with them, is how do they blend the portfolio like this? It's a pretty simple way to think about how you build a portfolio, but remember, it starts at like, you obviously have to see your financial planner, but it obviously starts out with like, well, what's my risk profile? And then how do I divide the risky versus non-risky? And then what goes into those major buckets? Remember the blocks before? Obviously, people want Australian shares. Obviously, people want cash. Obviously, people want US shares. Then you want some bonds. Even if you're a little bit younger, you would still, I think you'd still want either some cash or some bonds. And that's basically what we do as professional investors, is we look at something like this and we put it together. Now, there was a great question earlier on from, I think it was Deepak. I can't remember who asked the question. The question was around VDHG. Why not just use something like VDHG, which does it all for you? Now, VDHG basically goes like this and just takes it all, and you can just buy it all in one. They don't invest in gold, though. Vanguard doesn't believe in gold, which is fine by me because I honestly don't think it needs to be at least a huge part of any portfolio, to be honest. But they basically just do that. And that's a fine solution for a lot of investors. Now, I have an understanding of what's going on in the industry, and I did talk about this with Balaji the other day, who's been on the show before, Selfwealth Live. If you just Google Balaji and Rask, you'll find it on the Rask website. But Balaji, in this podcast, one of the things that he revealed, which I don't think he's revealed anywhere before, is he revealed that VDHG might actually soon turn into an ETF of ETFs. I don't want to bore anyone who doesn't know what that means, but in right now, VDHG and all those types of ETFs are like, when you invest in the ETF VDHG, what you get inside of it is actually managed funds, not ETFs. And there's a tax reason for that. So James, you said our corporate bonds included, not here, but you could include them on the more defensive side. So a corporate bond is, where would a corporate bond sit? So James, on this risk reward strategy, you can see it kind of here as a corporate bond. So it's like a bond, but from a company rather than the government. It might even be higher. Like honestly, it could be anywhere. Some of these hybrids that we see in Australia, in my opinion, are very risky. In my opinion, they're riskier than people think because they behave in unusual ways. So anywhere between here on this make-believe chart and even up to here, as risky as shares. So it depends on your view and what kind of investment it is. If it's a corporate bond, like how secure is it basically? And I just don't have the ability to explain all of that today, but I hope you understand. So Colin did say it doesn't look like a diversified portfolio. That's interesting, Colin. So Martin, you've said private equity. So private equity funds are a different kettle of fish. You won't ever get them in an ETF, but they would probably be more on the growth side. Some people might justify that they're slightly on the defensive side, but yeah. So that's interesting. Yellow Coal, you've asked, can you please explain the Amit cost-based changes with ETFs? I can get into that maybe in a couple of weeks, Amit. It just takes me a little bit longer to explain unless someone wants to quickly type it into the chat. So at the end of the day, this is just like a framework that you can build on. I don't recommend anyone follow this from today's show, but what I want to do is just explain to you how they can be used. There are risks in every type of investing. I hope by now everyone knows that they should seek financial advice, because I think let me be very clear. I think it's really important to get advice around retirement. I almost think it's like the single most important thing you'll ever spend money on as you come into retirement is financial advice, but also around other major life events, things like inheritance, having a family maybe. There are some financial advisors out there. I know there's some big scary numbers, but for people in their 20s and 30s, there are some financial advisors that can give you full advice for $3 or $4 grand. Now, obviously, as you get bigger in your portfolio balance and you get to more complicated things like retirement, it's going to cost you more. But you should expect to pay that for a professional service. So you can use the Money Smart website. You can use the PIFA website as well. You can even just ask people that you know and just test drive some financial advisors. Okay, so is this portfolio diversified? I would say yes. And I didn't actually finish the thing about my ETFs before. Okay, so with VDHG, this is the most important thing. I don't think, if you just take one thing away about my comments on VDHG or like any of the diversified funds from Vanguard, or even the one DHF, it was mentioned in the chat before, I think they're good starter portfolios. But I want you to imagine one thing. If the ETF that you're buying already does all of this stuff for you, right? What happens if in a year or 2 years or 10 years from now, you need to sell, or you want to sell one part of it because you want to rebalance? Let's say instead of having a 50-50 portfolio, you want to have like a 70-30, or you want to go from a 90-10 portfolio to a 50-50 portfolio. So like people going, I'm 40 now and I want to invest aggressively now, but in 5 or 10 years, how do I do it? And I think that's why Vanguard wants to move to ETFs inside VDHG, so that people will be able to split them out in the future. But that's just my belief. This is why I think for pretty minimal effort, I think people can build a diversified portfolio like with ETFs, as you may see in front of you now as an example. They can build a portfolio and then they can make enough decisions, but not too many that's overwhelming. So for example, if you decided in the future that, okay, I no longer want gold, or gold has gone up and I'm going to take that money out and put it into shares now, which is the whole point of a rebalancing act, you can do that. But with the other fixed strategies, you can't. Another way to deal with it is to have VDHG or DHHF or one of those big diversified funds in the middle, and then put ETFs around the outside. But again, you don't have as much flexibility. For me, this, as someone who does this day in, day out, this is the perfect blend of flexibility. For example, in our team, what we're thinking about is we're going to start our new portfolios with a set amount of cash, but then we're going to move it into the other parts over the next couple of years as we think the markets may mature. So that's the benefits of having some cash ready to go, is you can take it from here and just pop it in the other areas as the opportunities present themselves. Still long-term investing, not trying to time the market and do all that sort of jazz, but that's the general gist. I think I answered the question from earlier on there. Ross, you've said, why does everyone need professional advice when information is freely available? I have to keep stressing this, Ross, because I am governed by a financial services license, and I have to tell everyone here today that this is strictly general advice only. In Australia, the rules are incredibly strict. Someone like me, for example, can face up to 5 years in prison if I accidentally give advice and I'm not licensed, which is very different to the United States, where it's basically just a free-for-all. It's not quite, but it's a lot more loose. So I just say that as a general rule, and that's why we say get advice. But also, it is important to get advice, because I think, like, around those major life events, like, I'll give you an example. If you're approaching retirement and you've got $500,000, $600,000, $700,000, $800,000, who knows what you got, right? Just anyone generally. And you make a mistake with the tax rules, or you make a mistake with the pension rules, or you make a mistake with the superannuation rules or your retirement rules, that could cost hundreds of thousands of dollars over the next few years in that mistake, in terms of the mistake costing you $100,000 and not making a mistake making you $100,000. So that's why I think at critical moments in life, people who get really up in arms about paying $5,000 to see a financial advisor, I think just do it. You don't even if you just get the advice, it's a $5,000 cost that you might never use the advice, but at least you got the advice anyway. And at least you've gone through the process. Good option for your children, says Crisp, in relation to BHG. Cool. Shad, you've said, such a great episode. It's like an ETF explainer session for Australian investors. Just incredible that this is free on YouTube. Well, thank you so much. Dad, good YouTube handle. You've said, how about 5% into Bitcoin just in case it becomes quote unquote a thing? I think there's that old saying, like, get off zero for Bitcoin and those types of things. We could do a whole session on this, but I think, Dad, I love that I get to call you Dad because it's your YouTube name, is that I think that a lot of people have ended up in cryptocurrencies for the wrong reasons, not necessarily understanding the true value of the technology underneath it. It could become a thing, just like we could go back to gold. Some people still believe that we're going to go back to gold because of hyperinflation, which we saw after the Second World War, and we saw not hyperinflation, but we saw a lot of inflation after the Second World War. We saw it in the 1970s and 80s. People think we're going to go back to that, so they should own gold. There are a lot of things. Remember this, there are a lot of things that we don't know about the world of investing, that no one can tell you the specifically correct answer. So when you build a portfolio, you do not build a portfolio and you do not put all of your money on the line thinking that you have all the answers, because the moment you think that, you're going to be humbled. This is for everyone. The moment that you think that is the moment things will go bad. That's just a belief I have. So what we do when we build a portfolio like this is we try and be diversified, because that's one thing that we know we can get for free is diversification. You try and have exposure to different asset classes, not just 100% stocks all the time, like some people would have you believe, or not just one individual share or one type of currency or whatever. You build a portfolio so that it can withstand basically any type of future. So you have in this case right here, like I said, I don't have this, but in this instance, let's say inflation comes back and we're into a recession. Maybe some gold is good, because then you can take the money that is in gold that's doing well in a recession, and then you put it into the shares that are now cheaper. But maybe that doesn't happen and you end up losing some money on gold. Well, you'll probably lose money on gold because bonds are doing well. And that's how you build a diversified portfolio. So, that's all I can say. Okay. So thank you everyone for coming along. And Jimmy, you've said, great having a daytime for us night shift workers. Well, I hope this isn't the middle of your sleep time, Jimmy, if you're getting up for this. thank you everyone who's come along for tonight. Good question, James Long. Good point. You've said, couldn't the distributions from a VDHG or a diversified ETF be used to buy a separate bond ETF in the future? Yes, it could. Good point. You could take that diversified portfolio, sell a bit of it, or just receive the dividends and then invest it somewhere else. I just prefer a little bit more control day to day. So as I said, I'm on the road tonight in Newcastle. If you're anywhere in Newcastle, come and see us. It's an all-star lineup for speakers tonight. I'll be in Wangaratta next week for anyone that's in regional Victoria, or Sydney on October 3rd. We're also doing a value investor workshop. It's a full day intensive program with me and a fund manager. We're actually doing that, and it's going to be heaps of fun. We're actually doing that in the Magellan offices. So hopefully an analyst will come and give us a speech and do all that. So come along. It's all available on the website. Finally, a quote. You don't go broke taking a profit, eh? You also rarely get rich taking a profit. You had to sell, which is extra work, then buy something else, more work, that needs to do better. You also paid capital gains taxes, cha-ching. But sure, yeah, you don't go broke taking a profit. And this comes from the mighty David Gardner, the co-founder of the Motley Fool, one of the best investors probably on the planet. And he talks about this he loves to go against conventional wisdom. He just loves that conventional wisdom can be so often wrong. And it's one of that old cliches, you don't go broke taking a profit. David is one of the greatest investors because he didn't sell out. He kept on holding. And it's a leaf that I definitely take from his book, which is that I tend to hold my investments for years and years and years and years and years. And the saying that I like to have is kind of like, you want to be there before most people, but you want to be there after most people. And that's the true wealth creation. Like the Morgan Housel quote, 99% of long-term investing is doing nothing. The other 1% changes your life. Most people forget that when a stock or an ETF or an investment goes up, it can keep going up. It doesn't have to fall. People just believe like if you throw an apple in the air, gravity kicks in and it has to come back down. It's not the same with stocks. It's the stock market as a whole. It's not the same. So something to keep in mind. Okay, thank you everyone for coming along today. Sorry we went a little bit over time. I hope to see you on the road. Thank you to Rob if you're still with us from Selfwealth. I know you're having lunch, mate, so thank you for that. I will be back next week. As you know, we've got next week with Scott Phillips, same time, so midday. If you are watching this on replay at 6 p.m. tonight, or maybe 9 p.m. or 8 p.m. if you're in Western Australia, thank you for tuning in on replay. You can find all of the shows on the YouTube channels, whether you're on Selfwealth, thank you Selfwealth, or on the Australian Shareholders Association, thank you Australian Shareholders Association, or if you're on Rask, you can watch all of these on replay. Next week, we've got Scott Phillips, the great Scott Phillips. And then the following week, we've got a bit more of like a free-for-all Q&A, which will be a heap of fun. We have so many good guests, and I can confirm with you that I think Australia's #1 futurist is going to join us, Steve Sammartino. Thanks to everyone who commented last week. And I hope I can say this too, and I think I can because he emailed me back and he said, yes, he wants to do it. Dr. Sam Huppert from Pro Medicus, Australia's #1 company. So the best performing company over the past 10 years, the mighty Pro Medicus, the co-founder of Pro Medicus. He'll be joining us sometime in the next few months, which I'm absolutely positively delighted to be able to bring someone like that to you, and you can ask him your questions. So there's so much to come on the Rask Live, that's Selfwealth, which is the same thing, but on the live program. Thank you so much for this week. I'll be back next week. Don't forget to hit subscribe. It does make it better, and you will get notifications when we do go live in case you miss an email. Thank you, guys. Thanks for rocking up during your day. Thanks for sharing this time with me. And as always, what's the saying? I think it's something like onwards and upwards. Bye for now.